Namaste. In the previous session, we discussed about factors determining capital structure. Now, this session we shall be discussing about the meaning of fixed and working capital. Why is it so important, and what are the factors determining fixed capital and working capital requirements of a company? Now, fixed capital. It is that part of capital which is required for purchasing fixed assets and investments in future projects. Now, very essential is fixed capital management. Why? Because it is a very crucial decision to be taken with a lot of risk. So, fixed capital management is otherwise called as capital budgeting decisions. Now, capital budgeting decisions are the decisions regarding long-term projects. Capital budgeting decision is supposed to be very crucial because it involves huge investment. Huge investment, bulk investment is required, which means the organization cannot afford to take a chance. Fine. The next is it involves high risk. Wherever huge capital is involved, obviously risk also will be more. So the risk is very heavy. So they have to be very careful. So the decision should be taken very, very carefully, because the decision once taken will be an irreversible decision because it involves huge investment. When high investment is made, the impact of it is felt over a very, very long period of time. So it has a bearing on the long-term growth of the business. So any decision involving huge investment and for long-term purposes should be taken very, very carefully. Now let's discuss about the various factors which affect the fixed capital requirements of an organization. Now, number one is the nature of business. Now, if the business is a trading concern, their investment in fixed asset will be very less because they are mainly focusing on buying and selling of goods and services. So, at the maximum, they may require a weigh machine or a packing machine or a steaming or a seaming machine that way. So, for them, the investment will be comparatively very less in comparison with a manufacturing industry. Manufacturing industry, whether it is small or large, obviously they need to invest money on purchase of fixed assets like plant and machinery, installation of plant and machinery, then acquisition of land, buildings, etc. So that will definitely involve huge cost, and the quantum of fixed capital will increase with the size of the organization also. So larger the size, greater will be the requirement of fixed capital. The second one is large scale operations versus small scale operations. The scale of operations, a small scale business will require less fixed capital requirement because their investment in plant and machinery or any other fixed asset will be comparatively less or small than an organization which is involved in a large scale operation. So comparison between the Tatas and a small industry. Right, their investment will be huge because their size scale of operations is big. The next one is choice of technique. A company which is more labor intensive, they depend on the manual working. They will have more laborers to do the job, which means their investment in fixed capital will be low. On the other hand, if it is a capital intensive industry, a sophisticated machinery will cost heavily. So their investment in fixed assets will be more, therefore their fixed capital requirement will also be more. The next is growth prospects. A company which is in the growing stage will go for a lot of expansion proposals, going in for new ventures, etc., due to which their fixed capital requirement will be very high. On the other hand, a company which has come to the maturity stage, wherein there is no further scope for them to expand or diversify, their fixed capital requirement will be comparatively less. The next is diversification. If the organization is interested in going for a horizontal disintegration in the form of expansion of business, their fixed capital requirement will be moderate only because it's only an extension of the existing line of business. But if they want to go in for diversification, like vertical disintegration, their line of operations is going to change. For every branch of business that they are going to do, they have to acquire new machinery, new technology to be adopted. Therefore, their fixed capital requirement will be more. The next is financing alternatives. If the organization believes in outright purchase of fixed asset, their cash requirement will be more, fixed capital requirement will be obviously more. But on the other hand, if they go for lease purposes, like hire purchase system or taking the asset on a lease basis for say 11 months or 20 years agreement, etc., they don't need to spend money on acquisition of land, buildings, etc. The petrol bunks we find in and around our area are all on a lease basis. So they will be on a 99-year lease basis, 11-year lease basis that way, by which what happens is the cost of acquiring the land is not there for them. They pay royalty for the particular area that they enjoy depending upon their income also. So fixed capital requirement will be less if they go for lease purposes. If they go for outright purchase, their fixed capital requirement will be more. Then the next is level of collaboration. An organization which is going for single line of product and only one manufacturer dealing with that, their fixed capital requirement will differ from the organization which is going in for a joint venture. When they go for joint venture, the level of operations is going to be more and different technologies will be adopted. Obviously, the fixed capital requirement will vary. Fine. So these are the factors determining fixed capital requirements of an organization. So to reconcile, let us discuss about the nature of business. If the business is involved in trading activities, their fixed capital requirement will be limited to the extent of basic assets which are required for purchase and sale of goods and services. But if the organization is involved in manufacturing process, they will require more fixed capital for conversion of raw material into finished product. The scale of operations. If it is a small scale business organization, volume of operations will be limited, fixed capital requirement also will be limited. But on the other hand, they are into a large scale business, necessarily they will invest huge money on acquiring fixed assets. The choice of technique, a labor-intensive technology-based company will require less fixed capital because they need more of manpower. On the other hand, a company involved with sophisticated technology, acquiring more business machinery will be required, therefore they will require more fixed capital. Growth prospects, a company which is in the growing stage, the growth stage, the company will be investing more money in acquiring fixed assets and spending more money on long-term projects. On the other hand, a company which has already come to the saturation level where no further scope for expansion is there, their fixed capital requirement will be comparatively less. The company which is going in for expansion or diversification. Expansion requires only addition to the existing system, therefore their requirement will be comparatively less. But if they go for diversification into new line of business, etc., they require more fixed capital for further investment. The company which is going in for outright purchase of fixed asset will require more of fixed capital. On the other hand, the companies which are going in for lease agreement, their requirement will be comparatively less. And the level of collaboration that the business is venturing into. If they operate as an individual company or a single line activity, their fixed capital requirement will be different from the company which is entering into joint venture with other companies. So the resources of the other companies also will be there. Accordingly, the fixed capital requirement will change. So we discussed about fixed capital requirements. Now we shall be discussing about working capital requirements of the organization. The last topic of this particular chapter. Now, what do you mean by working capital? To define working capital, we can say that it is that amount which is required to meet out the day-to-day expenses of the business. To meet out the day-to-day expenses, whatever the fund that is required is called as working capital. How to arrive at working capital? Working capital is nothing but current assets minus current liabilities. Current assets minus current liabilities. Now, working capital is required for meeting of day-to-day expenses. The amount of working capital depends on certain factors. So, we classify working capital into fixed working capital and variable working capital. Irrespective of productivity, certain expenses have to be incurred by the organization, like office salary, office rent, office insurance, advertisement and sales promotional expenses. All these things will remain to be the same irrespective of the level of production, which we call as fixed working capital. So, irrespective of what happens, the organization has to have this much amount as working capital. On the other hand, sometimes the manufacturing industry might have certain raw materials which are available only during a particular season. So, they may have to acquire the raw material in advance and use it for the production process throughout the year. On the other hand, some finished products may be demanded only during a particular season, which means the finished product will have to be stored. So, for these purposes, they need more working capital, which we call as variable working capital or seasonal working capital. So, the amount of working capital will increase when the product has to be stored, and the amount of working capital will decrease when the product is sold in the market. Now, what are the various factors which determine working capital requirements of an organization? Number one is the nature of business. We discussed in fixed capital requirements that a manufacturing industry will require more fixed capital because they need more money for investing in fixed assets, etc. But does not mean their working capital requirement will be less. Obviously, their working capital requirement also will be more. When the business organization is big, obviously their fixed working capital requirement also will be more. Similarly, size of organization, scale of operations, large scale organization, when they invest more money on fixed assets, they may have to spend more money on maintenance of fixed assets, then operations for expenses, etc. Which means their working capital requirement will be more compared to an industry which is a small scale industry. The next is business cycle. During economic cycle, during boom session, that is inflationary situation, purchasing power in the hands of the people will be more. When they buy more production has to take place, which means more amount has to be spent on purchasing raw materials, etc. Then the economic cycle will revert. The depression will set in where people will not have sufficient money to buy. Naturally, production process will be affected. Then they may require less working capital. But again, this cannot be fully accepted because during depression also, people may not buy, but the manufacturer cannot stop producing goods for want of demand. He may anticipate demand to increase in course of time, so he may have to have more fixed working capital for producing production process also. So, factors determining working capital requirements in the nature of business. If the business is involved with trading activities like purchase and sale of goods and services, their working capital requirement will be relatively less than a manufacturing industry. Manufacturing industry will have to spend money on overhauling, depreciation of machinery, etc. So, they require more working capital. The next is scale of operations. A large scale industry will require more fixed capital and more working capital also because their number of employees will be more, then lot of activities in the organization, so which require more working capital compared to an organization which is a small scale business. Then the economic cycle, boom and depression. During inflationary conditions, what we call as a boom situation, purchasing power in the hands of the people will be more. More demand will be there for the goods and services. So the working capital also will be more because raw material purchase and other things until sales is generated. Then when the economic cycle reverts, then it becomes depression. People have less money, they don't buy the product. So the manufacturing industry cannot stop producing the product. This time now they have to spend money on warehousing. They have to produce and store the goods until the demand arises. This time also they require more working capital. The next is growth prospects. A company which is in the growing stage will go for additional raw material, increase in productivity, etc., or powerful advertisement to be given, sales promotional techniques to be adopted, etc., they require more working capital. A company which has a stable demand, then stable customers, they require less working capital. The next is level of competition. Now, if the organization is enjoying a monopoly, no competitor at all, then their product will be continuously demanded. So they require only less working capital because their sales will take care of their working capital requirements. But if the competition is stiff, many players are there in the market, then more promotional activities have to take place, quality control measures to be taken, so they require more working capital. The next is seasonal factors. Now, seasonality of raw material and seasonality of finished products determine the amount of working capital. The next is gestation period or production cycle. Longer the production cycle, greater is the requirement of working capital. Construction of a locomotive, the railway compartment, that requires a longer working capital because their production cycle is long. On the other hand, a company manufacturing ice, which is converting the raw material into finished product, that is water getting converted into ice blocks, their conversion time is very short, their requirement also will be less. Similarly, bakery, they also require only less working capital because their production time taken to convert raw material into finished product is very less, so their working capital requirement will also be less. The next is credit policy, credit allowed and credit availed. If the manufacturing industry or the trading industry is giving liberal credit, that means they sell goods and they collect money from their customers after a very long period of time, they require more working capital because their capital is blocked with the customers. On the other hand, if they have a shorter credit policy, they allow only less credit period, then they require only less working capital. On the other hand, when the raw material is purchased, a longer credit policy availed will necessitate only less working capital because they don't pay their suppliers now, but they convert their finished product, their raw material into finished product, sell it using the sale process, they pay off the suppliers. So, which case their working capital requirement will also be less. So, credit availed longer and credit allowed shorter, less working capital required. Shorter credit availed and longer credit allowed will necessitate greater working capital requirement. The next is operating efficiency. The efficiency with which inventory, receivables and debtors are managed will determine the quantum of working capital required. Minimum quantity of inventory maintained, shorter credit policy followed will make organization to use only less working capital. The next is availability of raw materials. If the raw materials are available throughout the year, then no need to pile up capital, no need to have more raw material, so they can be bought throughout the year. So the working capital requirement will be less. But if the raw material is available only during a particular period, then during that period more working capital will be required. The next is inflation. This is what already we have discussed. During inflationary period, more demand will be there for the products, more production activities will take place, therefore more working capital is required. So these are the factors determining working capital requirements of an organization. So let us revise. Working capital is the amount that is required for meeting of day-to-day expenses. Working capital is nothing but current assets minus current liabilities. Classification of working capital. It is classified into fixed working capital and seasonal working capital or variable working capital. Fixed working capital means the amount that is required on a regular basis to meet out the day-to-day expenses like salary, wages, then other overhead expenses, etc. Seasonal working capital or variable working capital is the one which varies with the level of production. Then the factors determining working capital requirements, nature of business, a trading concern will require less working capital in comparison with a manufacturing industry. Scale of operations. Large scale industry due to their volume of operations require more working capital. Business cycle, boom and depression. During boom period, people have lot of purchasing power, therefore there will be great demand. In this stage also the organization requires more working capital because uninterrupted production is required. On the other hand, when there is a depression, fall in prices, people have less money to buy, they may not buy. But in anticipation of demand, production process has to continue. So that time also the working capital requirement will be more. Growth prospects. A company which is on a growth stage will have continuous activities, their working capital requirement will be more. But a company which has attained the maturity stage, they may not have extended working capital requirement. Then, level of competition. A business organization which is enjoying a monopoly with zero competition, they may require only less working capital because their products are constantly demanded. But when there is a lot of competition, to have an edge over the competitors, the organization has to spend a lot of money in promotion of the products for which they may require more working capital. Seasonal factors. If the raw material or the finished product is seasonal in nature, either to purchase and store raw material or produce and store the finished product, more working capital will be required. Production cycle. Longer the production cycle, greater is the requirement of working capital. On the other hand, a short working period, the operational cycle will require only less working capital. Then, credit policy, credit avail and credit allowed. If the organization is able to get greater credit from their suppliers and they give only shorter credit to the buyers, then less working capital is required because what they have to pay, they will manage with what they collect from their customers. On the other hand, a liberal credit given to the customers and a short credit availed from the suppliers necessitates more working capital. The next is operational efficiency. The efficiency with which inventory, debtors and bills receivable are maintained determines the amount of working capital requirement. If more inventory has to be stored, more amount has to be spent on working capital because warehousing costs and other things will increase. The next is availability of raw materials. If the raw material is available throughout the year, then less amount is required in working capital because it will be met out of the sales turnover. But if the raw material is available only during a particular period of time, then more working capital is required. And the inflationary conditions. During inflationary conditions, purchasing power in the hands of the people will be more. More demand for the product will be there. Obviously, more requirement of working capital to acquire raw materials and meet out other direct expenses. So, these are the factors determining working capital requirements of an organization. So, in this module, we discussed about what do you mean by fixed capital and what do you mean by working capital. Namaste.